All right, Lee, one more minute and then we'll be ready to go.
I'm good.
All right, so I'm going to spotlight your video and you're going to be ready to start. We're going to have Lee Eisinberg present. He is I'm going to say owner operator. I'm going to let him do his own bio, but he is of Able Financial, which is a nice, large financial firm in town. I know a lot of people that are his clients and his partner's client. So I always look to him for knowledge on the market, volatility. And I think it's an awesome thing that he's giving of his time today to share with us a little bit about what he thinks is going on in the world, the roller coaster. In addition to that, though, afterwards, we will be taking questions. So stay on. I'll unmute all the mics then. You could also mute yourself if you have a question. And you'll be able to ask Lee questions directly. So we're ready to begin, Lee, whenever you're ready.
Sure. Thank you. I'll start with my favorite line that my mother always said I had a face for radio. So I don't know the appropriate format, but nonetheless, jump in and start. I'm one of the managing partners of Able Financial Group. I'm also chair of the Jewish Community Foundation of Greater Phoenix. So I'm involved in finances in a lot of different ways. These are extremely trying times for everyone. And I'm going to give you a quick overview of where we think things are and maybe what to do or what not to do. And so I'll start with, this is a fun ride for anyone. I'm just really going to focus on the stock market and investments, obviously affecting a lot of people in a lot of different ways, income and their business and things like that. But I'll kind of give you an overview. The market has somewhat over to the news, and the market is forward-looking vehicle. So the market, so the quarter hasn't ended. It'll end at the end of this week, and we'll be to the second quarter. So the first quarter numbers haven't been reported. So the actual effects of the slowdown in the economy happened yet, but we know that they're coming. We know that we're going to see reduced sales and revenue across the board for a lot of businesses. So we're going to see that in the second quarter and the third quarter. But the market, being a forward-looking, starts to price into what they think is happening. So the market is selling off and did sell a bit, but to some extent, it was what we call an oversold, meaning that it just the selling was maybe greater than it really should have. And now we're seeing a rebound on the other side. So there's some positive news in the last week or so. The virus is still very, very serious. It's not pains, and we don't know where sort of the bottom is with regards to the virus until we start to see a turnaround. But the federal government has stepped in and offered a bunch of programs and incentives that I think will help a deal, but there still will be some people suffering from the loss of income and maybe businesses closing. But what happens to us as individuals, we generally aren't wired well to investors, because we like the pain when we see our investments and our accounts go down. And today with technology, not only do we get news 24/7, but we have to our investments and we can see the values intraday all day long. And that's sometimes not a great thing, because we ride the emotional wave of seeing when it goes up or seeing when it goes down. And generally, when it goes down is when we're in. And our tendency as investors, we want to react, want to stop the pain, and we want to sell. We want to get out. We want to be safe. And our general advice has been across the board for all of our clients is to not do that. To take a step back and let's look at the longer term picture. So for most people that have money invested, they don't need that money tomorrow, but they need that money over the next, could be months, years, decades, etc. So they're often plans aren't necessarily altered by some shorter term volatility in the market, but their reaction to them can be. So we have a tendency as individual investors to react emotionally and want to get out, to reduce the pain. And when we do that, we want to sit on the sidelines for a while, and maybe when we hear it's improving, our friends or from television, then we'll want to get back in. And what we end up doing, which we all know is the opposite of what we should do, is we end up selling low and buying high or buying higher. So our advice in general is to sort of have some patience to kind of try and weather through the storm. It's a good opportunity to do some rebalancing, but the gut reaction we all have emotionally to do something at the time of emotion, generally not a good idea. And I've said this to a lot of my clients, but if you and your spouse have an argument in the middle of that emotional, argument or discussion, say that you might regret emotionally not clear senses, and you regret some of those things afterward. And same thing with the stock market. Sometimes when we're reacting emotionally, we're doing the wrong thing at the wrong time. And if we can kind of step back and take a breath, that's sort of things that we do. And I'm a financial advisor, and many of you have financial advisors. And I would encourage you to talk to them. We're trying to reach out proactively to our clients and talk to them and walk through, what's happening and explain it and have them better understand it. And I think that's a helpful process to go through. But our general advice has been to not get out when we react emotionally. The market's about to close in a few minutes. We're about 20% over the last 3 days. So we've seen a big, swift, a lot of volatility on the downward side, but we're seeing a recovery pretty fast. And kind of that was the message that we were giving our clients, that we thought if we get out, we may, missing a couple of days of recovery can have a big impact on our return over time. So, and I'm not saying we're on the road to, going straight back up, and I think we'll see some more volatility. The news coming out about the virus and the number of deaths and how it's impacting different states is going to get worse, not better, in the near term. And we're going to see, an overreaction on the downside and maybe a little bit of overreaction on the upside as markets recover. I think we're due for some volatility. So if you feel like you missed the opportunity to put some cash to work, if that was your situation, I think you'll have some opportunities. I think the market give us some volatility and bounce around, and we may test the lows again that we just had. But our overall view is it's very difficult to bet against the U.S. economy and the U.S. The U.S. individuals and U.S. businesses. They do a great job. And every time that we have a world event like we're having right now, everybody feels this is it's different this time than ever been in the past. But there's a lot of you on the call that have been alive a long time, and you've been through a lot of things. And we think back and we look at how the stock market's done over time. That happened at the time that I'm shocked that the world shocked the stock market, whether it was the Pearl Harbor, 1941, or different things, the oil embargo, Nixon resigning, 9/11, a lot of different things that happened that shocked the system, shocked the stock market, caused the market to sell off. But when we kind of take a step back and look at the long path, it'll totally move, and it should move higher. So it's not different this time. And what the good news is that this is an economic crisis. This is a health issue, health crisis, and that's certainly affecting the economy and business. But it was a very different experience, and a lot of us really didn't understand until after, much later on, what happened in 2008. But our financial system almost collapsed in 2008. We learned that after. Our financial system is in pretty good shape. It's going to be difficult to, get through in the sense of businesses losing revenue and spending, but there's going to be tremendous pent-up demand. And I use myself as an example. My wife and I had a trip scheduled to go to London the first week of March. We waited till the Friday. We were leaving on Sunday. On that Friday before the Sunday, we canceled the trip because we were uncertain if we get stuck there, or if we quarantined, or if we could get back. And we were seeing that things were getting worse. So we canceled the plane tickets, canceled the hotel. Spent there, isn't being spent there now. But our plan is to go in the fall, maybe October, maybe November, to book when when things are clear. We're going to spend that money. We're going to, put that money back into the economy, back into the airline, to the hotels. And that's the case kind of across the board for a lot of businesses. So their revenue may be down for the year, but once we get past this worst part of the virus and we start to get subsiding, I think we're going to, and people can back to a more normal life, then I think we're going to see the economy recover nicely. Businesses doing well, and there'll be pent up demand. I know a lot of people, it was spring break here in Arizona. Some people would have gone or were planning to go to Disneyland or Disney World for that vacation. They didn't because of the person. The park is closed, but their kids still want to go. They're in the fall or in the summer or another time this year. So there's a lot of pent up demand, and we're all stuck in our houses for the most part, and it's very difficult and challenging. But when things are better, we're going to recover. But that being said, if you look at certain companies, they're definitely going to be greatly affected by this. Hospitality industry, hotels, airlines. Some of my clients have been asking me to buy stocks or hospitality stocks. I don't think there's investments right now. There's still a lot of uncertainty on some of those. Some of those businesses may fail. I'd rather trade on if people had cash, to put money to work in stocks that were beaten up. Expression that many of you've heard: you throw the bath water. So when the market sold off severely, everything kind of got sold off. We're not as affected by the coronavirus or all sold off. So companies like Microsoft, that it may have a little slower sales, but they're not retail business that they're relying on foot traffic, and generally their business should be pretty good this year. It'll probably be off from what they anticipated it to be for 2020. But there's an example of companies like that that are going to be that got sold off. Prices went way down, but they're probably good investments, good buys. But the hospitality, the airlines, I'm cautious that I'm concerned in my approach to managing money and to picking stocks. And I think that there could be some nice recoveries for some of those, but I don't know how long before they recover. And there's some very high costs, like in airlines, with unions and legacy costs and fuel and things like that. So it's not always the best business to invest in any event. But I kind of close my comments, and I'll open it up to questions. But I'll close it with what Warren all know, a student investor ever. He has a saying that says, "Be fearful when others are greedy, and be greedy when others are fearful." And so people are being fearful this time that a Warren Buffett will go in the market and buy companies, stocks. He actually buys the companies, but that he thinks are a good value, because everybody's fearful and they're running out, in the opposite direction. But right before this happened in the middle of February, we also hit our high mark for the stock markets. People were being greedy. People calling and wanting to some of the stuff like Tesla, things that they thought that they could participate in. Was it the height of the sort of more of that mentality, that people that wanted to put some more money in and buy things that were maybe a little bit too speculative? We'd certainly caution things like that. I think we have to be patient. It's difficult, and everyone thinks that their time is shorter than it probably is. I was talking to a 95-year-old client earlier. She wants to reduce her risk. I would bet that this client is going to live for another 5 years. And if you get out of the market, if you got out of the market this week, you missed that 20 over what you lost. So, stay in the market is generally a good thing to do, but really looking at what the kinds of you own, and maybe it's a good opportunity to rebalance. One of the things, quick, and then I'll turn it over. If you have investments in taxable accounts, last couple of years, we've had some really nice gains, and you have the opportunity to take losses. Taking a loss in a taxable account is advantageous to you. And if you take that loss, if you sell some positions, you can rebuy them in 30 days, 31 days. You can buy a comparable company. But if you take those losses, you can use those here or in the future against ordinary or against capital gains. So if you took a loss of $10,000 from some stocks you owned, you can use that against a future capital gain. also use it against your ordinary income. You can reduce your income by $3,000 a year. I'm not trying to give you tax advice. I would definitely recommend that you talk to a tax professional, a CPA, somebody that maybe helps you with that. But take losses is a good strategy to do, and the market's giving us an opportunity to do that. So I would recommend if you take a look at your taxable account. If it's a retirement account, that doesn't really apply. Anyway, I'm going to open it up and see if there are questions I discussed or anything more that you'd like to know about.
I just unmuted everyone, and if you do have a question, you can definitely speak up, and Lee will hear the question. If he doesn't hear it, we'll up for you. Anyone have any questions for Lee?
Yeah, Lee, I have a question.
Who is that, Lauren?
All right, this is Lauren Greenberg talking.
So hold on, I'm going to mute everyone and unmute you.
Lauren.
It has to do with the bond. Has to do with the bond market.
Lauren, I see you're
I'm
on.
getting feedback. I don't know why.
Are you on a speaker as well? Try speaking now.
If I just type the question, will that work?
Yeah, type the question and I'll read it out. In the meantime, does anyone else have a question? Hold on, I'm going to unmute everyone. Anyone have a question?
It's muted.
Pinky does.
Pinky?
Pinky.
All right, Pinky, speak up. I think you're too far from the mic.
This is
Can you hear me
I
now?
have a question for you. Someone wrote in a chat.
Oh, all right.
So I'm going to mute everyone for a minute and then unmute Lee. All right. So Lee, here is the question that someone wrote in the chat. Does your company have a formula for how much risk one should take? And it's like a two-pronged question. This is from Izzy. He said, your company has software balancing your client's portfolio. Should this calculation be redone under today's circumstances? So I'm not sure if that's two questions or not.
The first question is, we do have risk tolerance kind of questionnaires that help us. You know, we all think that we want to take more risk, but when the market goes down, feel willing to take risk. We do have tools or assessment tools for risk that we can want to take that helps them determine their risk tolerance. Today, everybody's risk tolerance is reduced. You know, if we were 4 weeks ago and it was the mid of February and the market was soaring, I think people would have answered some of those questions differently. So it might be a good time to retake some of those risk tolerance questionnaires. So the answer is with tools to help us to figure out what risk level you're comfortable with. But this time it sometimes changes with events as well. The second question was about rebalancing. I'm not sure if I...
Hold on, I'll read it to you again. The second question was, your company has software balancing your client's portfolio. Should this calculation be redone under today's circumstances? In other words, if someone had a meeting with you, let's say a year ago, or I guess on a portfolio, should they revisit it with you?
Yes, so absolutely. Rebalancing is a way or a method to sort of force some ways to sell low. So in simple terms, if you have a mix 60% in stocks and 40% in bonds, and a year of time goes past, typically that won't be a 60-40 mix change. The stock will grow more, or bonds will have grown more, but rebalancing kind of forces you to do that. So yeah, it's a good opportunity to rebalance, and in some cases, maybe putting more money into these which have been beaten up, and maybe bonds haven't beaten up as much, be buying again lower with the opportunity for those to increase in value. I don't know if I answered your question, but if not,
I'm going to let him chat that. So I'm going to unmute everyone again, and then if anyone has a question, just let me know. I'll mute everyone else and then leave you unmuted. Lauren, did you want to try this again?
Yeah.
Lauren
Listen.
Greenberg, if you shut off your speaker, it might be the trick.
All right, I typed it. Wait. Hold on, you still getting the same feedback?
Shut off your speaker and then,
Yeah, I guess you are.
okay. So we'll wait. I'll unmute
Or am I,
you.
or am I just sitting too close to it?
Hold on. We're still getting all the feedback. All right, hold on, Lauren. I'm gonna unmute you again, but I know that it's catching a microphone or it's catching something in your room. So,
How?
so do you know how to chat it?
Yeah, I don't know how to send it.
So hold on, I'm gonna let you try to chat it. If you click enter, if anyone else has a question, if you don't mind raising your hand, and I will.
Have a question?
Did anyone here have a question? I know that. Anyone else have any questions on here? I can go through the names if you'd like, or Lauren Greenberg is trying to figure it out.
I think he question. Can you hear me?
I
Can
hear you,
speak?
yes.
So maybe I'll just jump into something. He started to say something about fixed income. So not only did stocks sell off, but basically bonds sold off too. So the value of bonds and bond funds, was reduced as well. We're in a very
Hold on 1 second. I'm going to mute everyone and unmute you. Hold on.
Okay.
All right, go for it.
I know that Lauren had a question about, I think it was bonds, and I'm just going to jump in because I didn't really talk about that. But bonds, which are part of fixed income, also sold off severely in the last couple of weeks. Sometimes be a safer haven, and they can do well when stocks go down. But in the last week or two, a lot of bond funds have been, sold off and are worth less money. We're in an extremely low interest rate environment. So, for those of us who want safety, don't want to risk, putting money in a CD or putting money in a savings bank is yielding very low interest rates. And it's very difficult. The interest rates that banks are paying for CDs is below what inflation is. So you're not losing any money. You're not keeping up with the pace of inflation. So it's a difficult environment because bonds also were affected by the coronavirus and by the sell-off. But I think they're coming back to more normalized ranges as well. But we are in, and we will be in, a low interest rate environment, which has caused people to maybe take more risk over time because they can't get the income or the yield they want from that portion of their investment. So they put it into the stock market. There's a lot of great companies that paid dividends that have a track record of paying those dividends. And many of those companies, even though they'll be impacted this year, will likely continue to be able to pay those dividends and maybe in the future increase those dividends.
Okay, and then I have another question that came in chat. A friend of mine proposed a risk formula. One should be liquid or have fixed assets in relation to one's age. In other words, if you're 75, then 75% of one's portfolio should be risk-free. How do you feel about this formula?
It's not a bad formula. And the challenge, as I was just sort of alluding to, is that historically, we've never been in this interest rate environment. So for those of you that are older than me, you've never seen the 10-year treasury or any of the treasury bonds having such a low interest rate. Challenge is that if we use that formula, it's going to tell us that we maybe have certain percentage in fixed income or in bonds, and we're challenged with low interest rates. We're challenged with interest rates go down, the value. There's an inverse relationship between the price of a bond and the interest rate. So as interest rates have gone down, generally speaking, the value of the bonds have gone up. They're more attractive. We issued a bond years ago, and it was a 5% bond, and now interest rates are 1 or 2%. That bond is worth more than what somebody paid for it 5 years ago. But we're in a low interest rate environment. We're likely in the future headed up. So having answer the question is the formula in general, but you have to look at it closely because buying too much in fixed income or having too much in there is going to reduce our income because we're at such low interest rates that we may have to find some alternatives.
All right, I'm going to unmute everyone. If anyone has a question, we're going to try this again. Does anyone have a question?
I have a statement.
Let's hear the statement. Who's that? Herbert?
The word is, I think the word is hang tough and don't do anything. If you had it.
Hold on one second. I'm gonna mute everyone except for you.
If you
All
were
right.
lucky enough to be fairly well invested, maybe you should hold on and let things change a bit as you're going. A lot of us are stuck with RMDs, which means that, you know, after 70, you have to, good Lord, I just lost
All
everybody.
right, we still hear you though.
Okay. A lot of us are stuck with RMDs. So we're taking money out where the money that we have in there is not nearly as much as it used to be. So we're selling even though we don't want to sell, just to, you know, just to break out even. Our income usually is from IRAs and RMDs. And this is a bad thing, except that selling is even worse. So the question is, do we hang tough or what do we do later?
So it's a great question. You can hear me, I guess, now?
Yes.
Yeah, I can hear.
Great. So two things. So in 2018, the stock market was down, and the silver lining to that was that everybody's RMDs were reduced 2019. So they take out less money last year, and then the market appreciated nicely. The RMD is based on the closing value of your IRA on December 31st. So everybody's, generally speaking, IRAs increased nicely in value, even RMDs they took out. So this year and based on their age as well, they have to take out more. So that and their accounts have dropped, you know, dramatically in value. So we don't have a crystal ball, but one thing you can do is, so a lot of people take their RMDs out every month as part of their income. You have to take by December 31st of 2020 to meet the RMD for this year, but you can stop it. If you're taking it monthly and you think the market may recover, you might say a couple of months and not take money out of the IRA for now, it hopefully recover and then take it out later in the year, maybe third quarter or the fourth quarter of this. So that would be one thing to consider. We don't know where the market's going to go, but I would predict that it should be in better shape later in the year.
Thank you.
All right,
Sure.
I'm going to unmute everyone, and if anyone had a question, you can speak up. Anyone on have a question? I know that it was quite informative.
Yep,
Very good.
very good.
So thank you, Lee, for everything. And let me just check if there's any more in chats. No, I think we're good. All right. So thank you, Lee. We appreciate your time.
My pleasure. And if anybody has any questions after this, they can get in touch with Lee and he get in touch with me. I'm happy to answer any. If you have personal questions that you want to share with everybody, I'm happy to help you.
All right. Thank you.
Thank you.
Stay safe, stay healthy.
Thank you.
Everybody be healthy.
Thank you. Take care.
Now, if anyone wanted to stay on and just chat, we're available.
I have a
How is
question.
everyone holding up?
Good.
How do you do chat instead of just ask a question?
I have
You've
no
referred to
clue.
this. Oh, okay.
No,
you
I do know how. I do know how. It depends. On the bottom of your screen, there is I'm going to call it a bar of available actions. One of them is chat. Do you see it, Joan?
No, not of mine.
Well, move your mouse.
Oh, I just touched the screen and on the top I got some stuff.
Okay, so you might have it on the top. Oh, you're using an iPad?
Yes.
Closing.
Yeah, so on an iPad, you can do that.
Okay.
On the top. On a
and
computer, it's at the
chat,
bottom. On an
I
iPad, it's
see
on the top.
Okay, I found it. Thank you.
All right.
Take care. Bye-bye.
Thank
Yeah,
you.
take care.
Bye.
Thank you.
Bye-bye.
Bye.
Bye.
Thank you.
How are you, Elaine? and
Bye.
Michael, Jackie? And
Thank you.
Fine. We're fine. Thank you.
Phyllis, you have
Yes.
some more Prescott people here.
Really?
The Cateses.
Well, not
Oh,
anymore.
hi. Oh, hi